keep me honest. And we're gonna go to full screen. Make sure I don't lose anyone here. Sydney, you'll probably keep an eye on the chat. I'll have it on my side screen just in case. I love to answer questions as we go through to make sure it's relevant and timely and that you're implementing all the things I'm sharing, of course, every single thing, right? About financial management in your business. Oh, welcome to my workshop. We're gonna talk about, so you got your P&L, now what? I get this question a lot from people in business that maybe said, hey, I didn't go to school to learn money or how to manage a business, but I love what I do and I'm really good at it and I want to do it for a long time. And having a profitable, sustainable business is what's gonna keep you in business for a long time. So let's make sure that that's happening. And if it's not, that we give you some action steps to take so that you can go back to your business and start implementing some of those things and closing those gaps that will help you be more profitable and sustainable long term in your business. Um, I think I skipped the intro slide, so I'm just going to do a quick intro before we get into everything. So I'm Carla Titus. I'm the founder and owner of Wealth and Worth Within. We are a fractional chief financial officer, CFO firm, and we help clients with consulting and advisory services around their finances. Business owners like yourself that maybe are growing, have a lot of questions, and don't have the money team in place today that's helping them answer some of those questions. So today I'm going to share a lot of the work that we do behind the scenes with our clients to support them and enable them to get financial clarity and also feel in control of their finances and start to get some of those answers to the questions that you're asking. They're actually in the numbers in your statements. And I'm going to just share with you how we think about reading those, how to interpret some of those statements, and how to start getting answer to the questions that you probably feel deep in your gut and you're like, something is off. I don't know what it is, but I know something's off. And then we're going to show you where to find it in the numbers so you can start getting more clarity as you go through. Okay, please, please, please tell me about your business in the chat. I see a lot of you are already telling me more about it. And then drop any questions you might have as we go through, or raise your hand or unmute. I'm happy to answer as we go. It makes it more relevant and a more exciting and entertaining workshop after lunchtime here, at least where I'm at, so that we don't have anyone dozing off in the content. So, okay, you guys ready to get started? Give me a thumbs up in the chat or like physical. Yep. Okay, perfect. Awesome. I see some of you. Awesome. Thank you. Let's get right into it. Okay. So my whole career was predicated on finance. So I'm gonna demystify some of the terminology around financial management that you probably get confused by because nobody ever told you it was like super simple, and smart people want to make you feel like you don't know what you're doing and that you need their help, but we're not here for that. So we're going to go through a lot of terminology together. And I've been a CFO for 8 years in consulting, 11 years in corporate finance. So I do know a thing or two about managing money. So please, please, please ask me questions. I want to make sure all of those get answered as we go through. Okay, so what is a P&L? Let's start there. So profit and loss statement, which is also referred to as an income statement, for those of you who maybe have dealt with a bank at some point and they're like, can I see your income statement? You're like, I don't know what that is. Do I have one? Yes, I do. It's called a profit and loss statement. And P&L short for profit and loss. And this is the report where you were going to get insights around your profitability as a business. This is not the cash side of the business. We'll talk about that in a little bit. But this is the profit. Are you making money after you pay everyone and everything? And this is a critical question for business owners to, one, know and understand. And those of you who maybe don't even look at your report because you're afraid to see what's going on, and you're like, I don't know if I can look at it this month, or maybe last month was really good, this month wasn't so good. So you're like, we're just going to skip this month, and next month we're going to come back at it when things are good again. We need to understand, why are things not performing well financially, right? So the more you know, the more data you have, the better you can do managing your business. Now, every business has seasonalities. We'll address some of that. Every business has unique things that happen to them, one-off situations, and we want to be prepared for that. But we also want to identify what commonly happens in our business. Are we growing? Are we charging enough? Are we making money? Like, this is a critical one. I don't know how many of you ask yourself this on a month-to-month basis. Of course, I'm attached to my numbers every single month, so I know exactly what's going on. But for those of you who don't do this for a living, you might be like, maybe I don't want to look at it, or I don't have time. It's not a, maybe don't get too prioritize, because we literally are business owners, and I'm one too. I get asked for 200 different things at any point in time in the day. And you're like, the last thing I have time for is to look at my financial statements, right? You're like, I got to deal with this fire, and this employee needs this, and then this happened, and the customer's not happy, or whatever it is. So the importance, though, that your financial statements get reviewed is highly critical for your business, because these are the points of data that you need in order to make informed business decisions. So when we talk about the financial side of the business, we really need to be in tune with what's happening in our numbers. Did we spend too much? Did we make double the money we thought we did? Like, what a blessing. Let's do more of that. Did we start a new line of service and we're trying to figure out, is it working or is it not working? Right? So how would you know unless you're measuring it? That's always my question to business owners. How do you know unless you're measuring what's happening? And data is just data. I know we put a lot of layers to money management, our own personal, experience around money. But if you just think about your profit and loss statement as just information and data points, no reflection on who you are as a business owner, whether or not you're doing a great job or not, like no judgment, just data points. We can more objectively start looking at that information and say, well, if we don't like it, we can change it and we can do something differently going forward. So you're going to use your profit and loss statements to identify what are your strengths and weaknesses in the business. How do you do that? I'm going to walk you through an example. So just hang in with me. I'm going to get through a little bit of the theory and framework, and then we're going to get right into an example so I can show you live what that looks like. There will be trends. Maybe your revenue is growing month over month, year over year. You're actually ahead of last year. But again, how do you know unless you're looking, unless you're measuring, unless you're comparing last year to this year, last month to this month? Are you guys doing any of that? Give me a thumbs up if you are, and a sad face if you're not. Because, not everyone has time to do it. So I understand. No judgment here, just more like, where are we at? So make sure you drop it in the comments. And then weaknesses. Are we overspending in some areas? Is that the right allocation? Do we need to change it going forward? Do we need to make a different decision to adjust that? And again, how would you know unless you're looking at that information, right? So these are the things that we're evaluating for. Now, showing profitability is key for long-term sustainability of the business. I already said this before. But understanding what are your trends in the business so you can make sure profit is happening, make sure you're controlling costs. If it's time to increase prices, that one, if you take nothing else away from this, evaluate, is it time to increase my prices? Because you probably haven't done it in the last year. I bet you a lot of you have not. Let's just evaluate. That doesn't mean we have to raise them. We just need to evaluate to make sure we're still good there. Especially with everything happening in the environment, we need to be able to respond to economic changes, competition changes. Like, we need to be on top of our pricing at all times. And you want to make sure you're looking at trends both on the revenue, on the upside, on how the business can grow, the top line piece, and all the costs, how you're spending money and where it's going. If you can't answer where you're spending money and where it's going, and it's not aligned with your plan and your strategy for the business, maybe it's time to make some changes. Maybe we want to reallocate from one bucket to another. But how will we know what that is unless we're looking at it? Okay. Okay, what questions come to mind from that aspect of profit and loss statement? Are you guys looking at it? Are you reviewing this monthly? Drop me some guess in the chat, or not really. Okay, so I have a question. What is the best way to track your spending? Great question. So if you don't have accounting software already, that's always my recommendation. Let's save time. We don't got time here, right? Like, it's cheap enough. Let's get it hooked up to our bank account. Let's figure out what's going on there. But you also have to maintain it. So you need to make sure that that's happening too. A spreadsheet, like it could literally be pen and paper if you want to. I really do not have a preference, except I like to save time. So I like to automate things. But if it's pen and paper, track your expenses, you know where your money is going, who you're paying, how much you're paying, what for, especially what are you paying for? What's the benefit you're getting for that expense? Are you getting something in return? Ask yourself those questions. You'll be surprised the things we're spending money on. So tracking, automated ideally, hook up, QuickBooks online, accounting software tool, keep up with it, maintain it every month, because that will start to give you some data points, right? So if you don't have your P&L built out yet, now it's time. It's time because as a business owner, you will be required these documents if you ever want to apply for a loan. If you want to finance anything, the bank is not going to give it to you based on your written records. So that's going to be a hard sell. Maybe a spreadsheet. You could probably get away with a spreadsheet, but even better if it's a reporting that has been done monthly and reconciled and is tied to your actual financial records. Okay, so I see some of you track monthly data. Great. Never looked at it. Okay, so we're going to start now, right? Because we got to review and see what's going on. Because what gets measured gets managed. So if you guys haven't heard that before, that's very real. You want to see results, you want to be profitable, you want to make more money, you want to pay yourself, you got to be looking at the numbers. Again, whether they're bad or good, doesn't matter. Like, it's where we're at today. We're measuring this point in time. We can do a lot of things to change that going forward, but we can't do anything if we don't know what's going on. Okay, once a year in the winter, you guys must be busy outside doing all of the work. And yes, some of you can relate. And this is true, right? You're busy farming in the field or doing whatever it is your job is that takes you away from the computer, and there's no time for this admin work, right? And you're like, oh, I'll do it one time someday. At tax time, I get this a lot. I will look at it at tax time because my accountant makes me and I gotta file taxes because it's compliance. Don't wait until the year end because there's nothing you can do to change it. That's why we don't wait. We need to look at it every month, because if we want different results the next month, I would even say you have to look at it twice a month, because I check middle of the month to see if we're on track for our monthly goals. Because then I can go tell the team, hey, we're not on track. We need to double down. We need more sales. We need whatever it is we need. We need to spend less, half on this thing that we were spending on, because we're over budget. I can adjust it and then get the intended result I want at the end of the month, but not if we're not looking at it. Okay, so there's some tracking happening, but not always comparing to last year. Ooh, key one. So you want to know, are you better or worse than last year? I have some clients that maybe are doing worse than we thought. We need to figure out why. First of all, the big question is, why are we doing worse? What's different now? And what are we going to do about it is the next question, right? To make sure we get back on track. Ooh, some of you get stressed. Oh, I got someone who reviews it weekly. Fantastic. I mean, props, because that takes a lot of dedication and discipline. So you probably know what's going on. And as a percent of total income. Ooh, we like it. We're going to get to that too. And then some of you get stressed. And then there's like supply needs that are happening. And then you're kind of just making decisions as things come to you, which is very common if you're in the thick of things. But if you had a budget allocation and you know how much you wanted to spend on a certain equipment per year, per month, then you wouldn't be just guessing. You would be working against that budget you allocated, right? So now decisions are easier. Now you have permission to spend up to this much. You're not having to check your budget every time because you're like, oh, I spend $5,000 out of my $20,000 allocation. I'm good to go. I got another 15 to go to make decisions on, right? So we're not having to go back to the spreadsheet to check. We know what it is. And then you guys have some support with your accountant. Fantastic. Review it with a monthly bookkeeper. What a great accountability. By the way, if you don't have a bookkeeper, you've outsourced this too. That forces you to meet every month to look at your numbers. That's a great way to make it happen, because you're like, I'm paying for this. It's going to happen. You might not meet with yourself, but you will meet with someone else. Oh, so restaurants. Some of you who had restaurants before, you looked at it every week because you were like, we're going to be out of business in the second week if this doesn't change, right? So you were like on it, or you're like, this week was great. We need to do more of that. Okay, so a lot of comparisons. Oh, some of you are projecting. Fantastic. Like, you guys have really good, tools that you're utilizing. We want to do more of that. And then in the busy season, maybe they're a little less oversight on the financials, but we understand like by product type expenses. Okay, some good things happening. Okay, Okay, some of you help other people find, the hidden profits. Actually, great segue. Whoever posted that, thank you. We're going to go into finding the hidden insights in your P&L, which is a great way to start using the data to start getting the intended outcome that you want to see in your business. So we talked about comparing expenses over time, right? So what we're looking for is trends. So when I'm staring at a profit and loss statement as a CFO, what I'm looking at is, okay, every month in that category, I'm spending about, let's say, $2,000 a month. All of a sudden, I see a spike that says $8,000. Oh, you bet I'm asking questions. I'm like, oh, so what happened? And then maybe we get some straight answer. Oh, we did a one-time investment on this thing that was about $6,000. So it won't happen again. It'll go back down to 2,000 going forward. Great. It was intentional. It was a decision we made. We knew it was a one-time thing. We're not going to have this problem going forward. Right now, we're going to ask what benefit we're getting out of that 6,000, but that's a different conversation. But from a trend perspective, I'm looking for stability. And then there's times where it's going to be more like this. But even in that, I'm looking for the same rhythm, right? It's like 2,000, 4,000, 1,000, 2,000, 4,000, and not exactly, but roughly that. Then I'm going to understand, okay, that's the flow of the trend. We're good. Not going to ask questions. I'm also going to look at last year. I'm like, is this common? Does this happen every time? Or is this a one-off? So you want to compare trends over time to understand what's happening. You want to understand where are your profit leaks. And this one, you have no idea how straightforward this exercise is. So if you haven't looked at your expenses, even just for this year, don't even go back to last year because that can feel overwhelming. Even year to date, what have you spent money on in your business? Are you still getting the benefit, or do you still need to spend that same money in the same way going forward? Because as business owners, we think when we make a decision, it's permanent, and it's not. We might have tried something for 3 months and it didn't work. We want to stop doing it. Or we want to evaluate whether or not we want to continue for another 3 months and measure the impact before we cut it off, right? We might be overspending. We don't even know. I have expense audits I've done for clients where we've found anywhere from $5,000 to $10,000. Things we decided on last year that worked for last year that no longer working for this year. There is $10,000 that we could have allocated to something else. So that is such a powerful and yet simple exercise. Go pull your expenses and see what are you spending money on, and hidden subscriptions. Did you add people to a subscription monthly software, that no longer works at the company and you forgot to take them out? Easy save money, right? Like you can imagine how many of those happen over time and they compound. And you might feel like, oh, it's not a lot, but it is an extra $8, an extra $20 here and there. And if you do it many times and you have a big company and organization, that might be a lot of money. So keep that in mind. Okay, spot trends that impact profitability. So the trends are going to be around overspending, spending in the wrong areas. This is a big one. So if you're like, I'm not growing, why is that? Maybe you're not spending enough in marketing. So maybe it's not about cutting back. And that's what I would say. Like a good CFO is not always just about cutting back. It's about spending at the right level in the right buckets. And if you don't know what they are, we can evaluate to see what are the needs. Maybe you haven't spent enough in your professional development as an owner to make sure the business can grow with you. You realize every time you spend on that, your business grows. Oh, there must be a connection. Maybe there's trainings that you're not spending money on for your team to be able to up level or upskill. And that could unlock the next level of growth for your company. Maybe you need to invest in a completely different new revenue stream that you have been dreaming of. And you're not sure what that's going to cost you. We're going to set a budget for that. We're going to start looking for that opportunity. Profits is not just about cutting back. It's also about growing the top line. If you can grow revenue and keep your expenses the same, you just got more profit. Is it possible? Sometimes it is. Sometimes expenses grow a little bit to be in alignment with. Not always is it, steady. So make sure you're looking for that. Okay. What comes to mind? What questions do you have? Anything you've heard on this topic, you're like, is this true? I've been told this. Go
Carla,
ahead.
could you give some more examples on, trends that might be impacting profitability or things that you've seen that maybe sneak up on people that they wouldn't see if they weren't analyzing their P&L on a regular basis?
Yeah. And one that's really sad but common is like, if you're not looking at your books, sometimes there's charges that are not valid, right? Like I have found fraud on my clients' accounts before they found it. We were able to flag it. It wasn't a small amount. Like even things that shouldn't even be there. Like, do you know what you're getting charged for? The other one is like if you're paying invoices and you paid it double by mistake, how would you know unless you're looking at it? Like, do you have a process to check? These things can sneak into your expenses, and unless someone is catching them, it's just gonna go unnoticed, right? Maybe you're spending too much because you made decisions and you didn't realize that you allocated too much to one bucket more than you thought you did. Like I hear a lot of clients at times, they're like, I'm just making decisions so quick. And then I hire all these people. And then before I know it, I'm spending $10,000 on support that I don't even know we needed. Like those bills add up. Or you sign a contract that has payments annually, maybe, right? And now you're about to get hit with $10,000 of expense you didn't know was coming your way. You didn't know, you signed a contract last year, but you forgot about it. So these are common, right? And unless we're looking, we wouldn't know. Let's see what other ones get out of increase over time. We talked about the software one. Sometimes even like merchant fees can be really ridiculous, right? You're like, why are you paying more than normal average? Should you be evaluating a new merchant service provider? Like these are the questions we want to be asking. Anything that goes up in price, why? Why are we paying more? Do we still need a level of support? Can we downgrade? Do we still need like the whole thing, or can we do with half the support and not have impact on quality, of course, and other things, right, that go with that. Sometimes even reworking the hours of your staff. I have some retailers that maybe don't overlap the right hours. They're not looking at their foot traffic data and they're not making decisions based on hours, based on when they're busiest. Maybe they just need one person, not three, right? So we want to be looking at that and understanding our capacity, our needs, and then labor cost management, especially if you have hourly employees. You have a lot of control over that. What hours they work, when do they work, how much they work, what are they producing, and what's their outcome? Because payroll tends to be our largest expense outside of rent, most likely, and equipment in you guys' case, right? So making sure we're evaluating for that. Is that getting out of control? Is that eating all of our profits? I see that often. I see owners that don't get paid and they're like, what happened? Why is there no profit and why am I not getting paid? Like, well, you hire all this staff. So now you got all the free time, but you have no pay, right? It's like, do you want to, take some of those pieces away? Do you want to be more efficient? Work with your staff to identify gaps and areas you can improve? All that drives profit. Every conversation touches money. So if you're not looking at your profit and loss, it'll be really hard for you to spot those things. Okay, so let's talk about how do you use the data to make strategic decisions. This is where we're going to go back to talking about pricing and managing what are margins. I'm going to walk you through how to think about margins and how to calculate that. But pricing is a lever. We can increase price, we can decrease price. Price combined with units is also another lever. We can go high volume, low volume, high price point. There's combinations of that. So you get to decide, do you bundle your offers to get a better price, drive average price of the order up? Have you thought about that? Is that an option in your company? It's pricing comes down to value. Like if people think they're getting the value for what they're paying for, they will open their wallets and give you the money, right? So if you're not articulating that value clearly, there's an opportunity there. Maybe it's not about increasing the price. Maybe it's what we reduce as the offer, but keep the same price. And there's that too, where now your ketchup is 10% smaller, but you still pay the same price kind of concept. Yeah, that is inflation. And instead of increasing price, which is one lever, they reduce size instead. Do you notice? Probably not, unless you're measuring, your all ketchup bottle to that. So those are levers you can pull in your business. Think about how that applies to yours, and if that's something that you can do. Margins is a function of how much price point and the cost that it takes you to deliver the service or the good that you're selling. So managing the expense side of this is going to be critical. Margins fluctuate depending on the business type. So I'm going to go on the spreadsheet to give an example of that, on how we think about managing margins, because it does pull on both levers, cost and price, or revenue increase. Planning for growth. So a lot of people ask me like, oh, when can I afford to hire? Or when can I afford to buy this piece of equipment? Or like, do sales need to be X in order for me to do Y? And the answer is like, yes, but we have to plan for it. So we got to sit down and run some numbers and scenarios that say, if revenue goes up by 20%, first you have to answer, how is revenue going to go up by 20%? Are you going to serve 20% more customers at the same price point? Are you going to increase your price and serve just slightly, more customers to get to the same outcome? Where's your growth going to come from? Is it a new service offer or an existing one that you're growing? And how you invest back some of the profit in the business is going to be a decision you get to make strategically. So you sit down and think, okay, where is there a need in my business? Do I need to invest in marketing? Do I need to invest in a sales team to grow my business? Do I need to invest in tools like resources to automate, streamline, make us more efficient? Because our save equal money save, less labor costs, right? So where do you want to invest your dollars back into the business? And one myth I will bust for you all is I can't have or I can't pay myself because I need to invest all the profit back into the business. You can pay yourself and you can invest back in the business. And there's a way to allocate that to make sure that you're doing both. And it's just in the priorities, right? What is a priority for your business? Do you want to grow the business faster? Do you want to make sure you're compensated? Do you want to do both? And sometimes we sacrifice one for the other, but that's not necessarily like the way you need to prioritize. It is one way to prioritize, but it's a decision you get to make. And how do you prevent losses? You got to look at your numbers. Like if you had a loss in a month, you need to understand why you lost money. Did your sales go down 20%? Is this going to continue? I would be very concerned if that happens and we didn't have answers. Why did sales go down by 20%? Was it an economic thing? Did the competition take our customers? Did we lose market share in some way? Did a competitor come in with a lower price and stole our customers because of the price point? We need to reevaluate. How are we comparing to the competition as far as what we're delivering? Like you need to understand what are the market dynamics to make sure that you're preventing those losses from happening. Maybe it wasn't revenue, maybe your revenue was the same, but you grew your cost. Like your costs are higher than your revenue. That will create a loss in your business. Is that permanent or is that a one-time thing? Did it happen this month? Do we expect it to happen next month? Or are we going to make a change to make sure that doesn't happen going forward? Maybe you're overstaffed ahead of a big growth spurt that you were expecting, and then that growth spurt didn't come. That's okay. Now you got to staff accordingly and allocate the right amount of people. And that's painful, by the way. People, hiring and firing is not easy. So be mindful when you're doing your plans around hiring. Is this for the long term? Can we at least afford to keep this, person hired for 6 months and cover their salary regardless of what happens? Right? So make sure you're prepared as an owner, take on that responsibility. And that is on the cash flow side. So I'll talk more about that in a bit as well. Okay, what questions come to mind?
We have a question in the chat from Melissa. What are recommended profit margins to plan for investment and growth? What are some ways to look at expenses for better margin?
Yeah, so I'm going to go through an exercise on percentage off, and I think that will help clarify, and I'll do it in a spreadsheet so that we're not, just talking hypothetical here. But profit margins, and depending on the industry, this will vary greatly, right? But as product-based businesses or CPG businesses, if you're in that, industry, then you're gonna see somewhere between 5 and 15% profit margin, maybe as high as 20% if you're really managing everything tightly, with some dedication. And this is before you reinvest back into your business, because the question was like, how do we invest for growth? The way you invest for growth is you take part of your profit allocation. First, you got to build cash reserves. Like if you ask me, every business out there that doesn't have cash reserves is gambling with their future. So you want to have a little padding on the side just to make sure you can weather the uncertainty of business. Business goes through cycles. This is just expected. We should be ready for it. So pile up a little bit of cash. And it's going to depend on like your amount of risk taking as an owner. So I have some business owners that love to have a year worth of expenses. Some are like, oh, you're crazy. Like I couldn't keep that much money in that bank account, maybe 2-3 months, right? So what lets you sleep at night? I want you to put that in cash reserves because you know, hey, we're covered if anything happens. Not only are we covered, but we have time to react to what's happening. And that gives us time to figure out what to do. That's why we keep cash reserves. And it starts there because before we start to invest in growth, because growth is expensive. I don't know how many of you have scaled your business, but it takes money and effort and it's not easy. So you're going to need to put money aside from the profit to reinvest back in the business at whatever level you're comfortable with. We normally try to give the allocation like if you're an owner, like you're keeping 50% for yourself, 50% goes back to the business. But then again, you still have to have that cash reserve, right? From the profit. So make sure you don't forget that. That's step one. And then how do you get better margins is you got to control those expenses or you got to grow revenue. And the ways that you grow revenue is, pricing lever, you can control cost, you can create a new revenue service offer, you can expand into another location or market, that you haven't been before, like expand your customer base. There's many ways we can, increase revenue. Maybe it's even through a new marketing strategy that you're implementing and testing. And then once you know it works, you can double down on that. So there's ways to do the margins as both side, top line revenue and reduce costs. The other way is we will measure margins by service line. So and I'll show you in the spreadsheet, but if you have 3 ways that you make money in your business, you sell product, you do a service, and then maybe you have an online offer. Then you want to measure, hey, when we deliver the service at this price point to these customers, what is our margin after we pay everyone who does the work to deliver that or that produces that product for us? And you measure margin by line of service. And now you get a little bit more granular because now you can manage what's happening in that and get more efficient or decide if you want to get cheaper labor, if that's an option. You can choose cheaper materials. Maybe quality is not a problem. Again, there's so many things you can do to change the equation on the margins, but you got to understand what are margins by service or product line if you want to get granular with margins. Okay. How is the P&L different for a for-profit company versus a nonprofit organization? So I support a nonprofit organization too, and they still aim to make profit. Just because they're nonprofit doesn't mean they're not allowed to make profit. In case you guys didn't know that, that's not a thing. Now, do they aim to break even to try to give every dollar back? Of course, but as an organization, they also need to sustain their long-term viability. So we always have to have some profit or cash resource to carry us through for the next year, because you don't start the next year with zero and then do millions of dollars in that nonprofit again. Like you have to start with something that's seed money every year as a nonprofit to be able to deploy services and support the nonprofit activities. So even as a nonprofit, you should be aiming to make some profit, maybe not as much as a for-profit as a percentage, or at least break even to make sure you're not, going in a loss every single month or year that you're running your nonprofit. So hope that helps. Let me know if you want to clarify on that one. How do you determine how much cash reserves? Oh, great question. Okay, I might go into the next one here in a minute. But so I mentioned like the whole, how much do you need to sleep at night? And it's gonna vary. Like I, as an owner, love to have a really beefy cash reserve. That's just because I don't want to have to rush to solve a problem when we have the luxury of time. And I just like know that my business can run for X number of months without me having to make a whole nother sale, and we will be fine. And I sleep better, and I know my team is cared for that way. If you're like, I'm a risk taker and I can just like wing it and I only need like a couple months to just get through whatever problems, by all means, that's the right cash reserve for you. What we recommend standard for clients is between 3 to 6 months of operating expenses. And that might not include your salary. It depends on, where you've bit based on your entity type. But that's kind of we like to guide. And then we actually put that money in a money market that's yielding interest every month. So your money's making money while you sleep. In case you guys don't have that, make sure you get one for your cash reserves, because you probably won't touch it. And then if you need access, it's accessible at any time. So keep it working for you. Okay, so I answered the cash reserves one. Growth expensive, quote of the day. Yes, please, because I don't think anybody ever talks about how expensive it is to scale. And honestly, scaling, there's going to be a lot of trial and error. So it's just going to be pricey. You got to test things to see what can work. Measure margins by line of product. Okay, so that one resonated. Yep, thank you, Sydney, for keeping that. And then it takes months, not years, to build the cash resource up. Yeah, I mean, if it's a priority, you can set aside every week, every month, a certain amount, almost like a paycheck to your business on the cash resource to start building it up. It doesn't have to be a lot. This doesn't have to be meaningful even, but you just got to prioritize that as step one. Once you have it, built as a cash reserve and you're good with the amount, move on to investing back in the growth and whatever else you want to see happening in the company. Maybe it's hiring more people so you can work less, have more freedom. So when I talk about equities and liabilities, yes, I can talk about that. Actually, I think that might be in the next slide too, so we can just kind of touch it all in that. So the equities and liabilities is going to be on your balance sheet. This is your second financial statement. We covered a profit and loss when we started. The second financial statement is balance sheet, and then your third financial statement is going to be the statement of cash flow. So the balance sheet, and not in priority order, they're all very important statements, by the way. So the balance sheet will record your assets, which is anything that you physically have in the business. Like think cash, think maybe equipment that you've purchased should be categorized as an asset. And if it's not, now is the time to add it to your balance sheet. For those of you who haven't, make sure you work with your accountant or bookkeeper to get that in the balance sheet. If you have vehicles, anything that you purchase that is beyond a certain amount. Normally, accountants, I think, will say after $2,000 or so price point wise, they will put it as an asset in the balance sheet. Anything below that will just be expense in the year it happened. I am not an accountant. This is not accounting advice. I'm not a CPA. Check with your own tax advisor, please. The liability side is anything you owe someone for. So think debts, credit cards, lines of credits, loans, investment money that you took on, you're going to have to pay that back. So those will need to be recorded as liabilities in your balance sheet. And there's like short-term and long-term. So there's, categories within that. So I'm just going to keep it at high level. And then equity is if you put money in your business to start a business, that is called owner's equity. And it should be recorded for that initial start of money you put in. Anytime you put money into your business as a personal investment to the business entity, because you're not your business, by the way, they're two separate entities. There's a you and there's an entity. Then you happen to work in the business and own it. You putting personal money into the business is owner's equity. So that needs to be recorded, and it hasn't. That's okay. Just make sure that gets accounted for. Anytime you draw money out of the business, you personally pay yourself something that's not through payroll, that's through draws. That is an owner's draw in equity. So it's like a counter to equity, right? It's going to reduce the equity. And then there's retained earnings, which at the end of the year gets recorded for how much profit was left in the company, which is what I meant by like how much you reinvest back comes out of that bucket. And then all three financial statements are tied together. So if you haven't seen that, I'm not going to get into that today, but they're all connected for a reason because they all tell the story. And if you never looked at your balance sheet, maybe it's time, because I want you to check, are your checking account balances correct? Or are they off? Are your loan balances correct? Are they off? Have payments recorded against it that you'll be making every year? I hope your accountant called this at tax time, but don't count on it. You're responsible for your books. So make sure you're checking that your owner's draws and contributions get captured on that or not. Now it's time to check. Oh, great question. Owners, draws, and distributions. No, they're the same thing. It's just how we call them. Normally people call them draws because they're like taking it out, but it's a distribution to the owner. So just make sure you label it the same in your balance sheet. Okay, keep dropping great questions. Contributions between a nonprofit. You mean money you're putting into the nonprofit to start, Jesse? Okay. Yeah, I think they're recorded the same way. I don't comment that. We don't do nonprofit bookkeeping, so I want to make sure you get the right support on that because there's very specific rules about how things are recorded in nonprofit world, and they have to pass audits. So you want to make sure you have a solid support that knows how to do that. And we don't do that type of work specifically for nonprofits. We don't do the CFO work instead. So I will have you check with your nonprofit accountant on that or bookkeeper to make sure that's recorded accurate. I don't think there's a difference, but again, don't quote me. I want to make sure you double check on that. Okay. Yay. Okay. Yeah. Boosting profitability with confidence. Let's get into that and then I'll answer some more questions. Oh, I said I'll type them up. So profit and loss, they're asking about the statements, balance sheet, statement of cash flow. We'll get more into cash a little bit later if we have time. Okay, so we want you to start thinking about forward looking in your business. So right now, all you guys have been doing is probably looking at what happened and then what happened in the past, right? So like present and past. You're like, oh, I know what happened. I made money or I didn't make money, or like I spent this much and then I made this much revenue. I'm like, it's time to start looking forward. So I want you to think, okay, what is going to happen in my business in the next month? It doesn't even have to be long. Like if you're like, I could not do 12 months, it's overwhelming. Start with just 1 month. In the next 30 days, what do I expect to happen in my business? What are some goals that you have set for your business going forward? Maybe you even have a yearly goal you're looking to achieve, but you haven't answered the how. That's what we're here to answer. You can set whatever goal you want. Anyone can be like, we're going to grow by double. I'm like, great. Tell me how. And that's where they go, oh, we have no idea. We just want that our goal to be our goal. And that's when plans fall apart because you're like, well, you don't have a plan. What actions will you take in order to achieve doubling the size of your business this coming year? You haven't thought about it. Is it hiring 2 more people to my team? Is it selling to 20 more clients? Is it building a new revenue stream? Is it doubling down on the one that's working? We're going to invest in marketing and do XYZ activities in order to make sure we reach so many eyeballs or customers that potentially can buy our offer at 20% of them buying the offer. Like, I don't hear the plan. And then people are like, why didn't we achieve our doubling our revenue goal? It's like, because you didn't have a plan. So let's outline the plan with those financial goals in mind. Okay, so you set the goal. Now walk backwards. What needs to happen in January? What needs to happen in February? What needs to happen in March? How are you going to get your way to this goal? And you know the how. You run your business. You know your business best. Who's buying from you? Can you get double the customers? And then when I start asking questions like that, clients go, I don't think so. I'm like, then how are you going to double your revenue? Is that a realistic goal or do we need to adjust it? Right. So we just walk backwards from that. And they're like, well, maybe we can get 1.5 times our clients. Great. What price point? Same offer, same price point? Okay, let's go with that. How many more would you need in order to make that goal? And then we do the math because you could do the numbers, right? And all of a sudden you're like, oh, we would need to sell 200 more in the next 3 months. And I'm like, is that possible? They're like, not unless we hire 2 more people. I'm like, great. Sounds like we have a plan to hire 2 more people to make sure we achieve that goal. So we start to kind of map it out, right? What are the steps? What are we doing? Make sure you used real data, like what you done before, maybe likely that you will do it again or even better. Now, think about the spending buckets you need to allocate in order to make those goals possible. I just walk you through an example of that. Where are you going to spend money in order to be able to allocate to this growth? But also, where are you driving efficiency? Did you automate a process? Did you streamline a process? Did you save hours in a process? And you know who's the best people to ask? Probably your team who does it every day. Do you guys have ideas on how to save time on this? Have you thought about how we can improve this process? Like they probably can tell you and you never ask them. Now's the time. So another piece of homework for you today. And we talked about saving for profit, allocating to cash flow for financial stability. That's what I mean by that last point, save profit, because everybody's like, well, I just have to invest my profit back in the business and I have nothing left. And then I wonder when I get in trouble and I can't make payroll and I have 2 weeks to make payroll and I can't make enough sales to make payroll, the bank won't give me a loan. That's the worst time to ask the bank for money. Like when you're in trouble, when you're can't make payroll, that's the last time they will always say no. Why? Because you don't have profitability to show. They want to get paid back. The bank is not a charity. They're giving you money with expectation that you'll pay back with interest. So make sure you get those lines of credits, credit cards, whatever you need for the business when things are good. And if you're not working with a CFO to help you with that, like now it's the time to go apply for those when things are good, when you have profit, when you have a solid record, financial stability. When you don't need the money is when you go get the money. So when you need it, it's available and accessible for you to weather a bad time in the business. Okay. So, okay, so some of you are doing some yearly projections, fantastic. And then they make a goal on paper, work backwards to achieve. Fantastic. So you guys are already doing that, some of you. And then some of you do scenario planning. I love this. They call it projecting over 20% and under 20%. I love it because what that means is that you're ready. If 20% down happens in your business, you know what you're going to do. You know what expenses you're going to cut. You have a plan. You're not getting caught by surprise. You already have the plan. You're just working the plan. You're not frantically trying to figure out in the midst of uncertainty what the heck to do, because that's the worst time for us to be making decisions as a business. Now, if your business is up 20%, I'm like, awesome. Let's save some money for those cash reserves, right? It doesn't come without trouble. I mean, growth is painful anyway. So if you guys haven't experienced growth, just you wait. It's not what people make it seem. It's like, let's just grow by 20% and like everything will work out perfectly and everything is fine and easy. Nope, not the case. Okay. And then some of your under 20% over 20% expenses. Yeah. And you know what? You have control over some expenses. So you also can do a scenario where you like don't increase expenses and like reduce that if you have to. Okay, keep dropping questions. I'm gonna switch my view to the example on the spreadsheet so we can do a little bit of work there live, and then I'll take some more questions that come. I still got time for questions at the end also, so just bear with me. Let me stop the share and reshare. Let's see, where are we at here? Oh, there we go. Okay, let me know when you can see. Are we on the spreadsheet now? Okay, awesome. I got some thumbs ups. Fantastic. Okay, so actually, I'm going to pause there for a second. Any questions on anything we covered so far? I see a lot of the comments. Some people have to drop. It's fine. There's a replay for this. So
Don't be shy, you guys. One of the great things is we have Carla right here and she can't get away from us. So if you've got some questions, go for it.
I am here for you for the rest of the time we have together. So please ask away. Even if it's like, what about my personal situation? This is happening. What do I do? If you want to talk about it, I'm all ears. Okay, advantages and disadvantages between a business owner taking drugs versus putting themselves on payroll. Okay, actually, let me start by, again, this is not legal or tax advice. I'm not an accountant or attorney, but please consult with your own before you do any of this. It depends on your entity type. So if you're an LLC or a sole proprietorship that doesn't have an LLC file, that's okay. You are not allowed to be on payroll. Like that's a rule. So if you're on payroll and you're in an LLC, that's a problem. Work with your accountant, they can help you reverse that. You should only be taking draws. Now, if you're an LLC that's filing as an S Corp, right? Now, by now, you probably are making profit, which is why it makes sense to be an S Corp. If you're not making profit, you should not be an S Corp yet. So again, check with your accountant, reverse that. It can be done. You are required to put yourself on payroll. Like it's not an option. Like you are now an employee of your own company running as a W-2 for your own paycheck. That is part of the cost of converting to an S Corp, which also comes with benefits because there's tax breaks and incentives, right? That you get to benefit from. And you have to run yourself on payroll. Now, what happens is sometimes people go to become an S Corp because they have a great year, but the next year they have a loss. That's a problem. You have more costs now. So make sure that when you make the election to move to S Corp, that you are profitable and you intend to stay profitable long term. That's not just like a 1 year blip. And hopefully that is the case. That's why we're changing. But you consistently have to perform, right? As an S Corp for you to get the advantages of that. And then you have to run yourself through payroll. There's not a different way. Now, the benefit is also not only do you run yourself on payroll, but you also are taking draws. So there's like 2 portions here working for you. So now you get that payroll taxable piece, like any employee out there who has a W-2, but you also get take draws as a business owner of the company. So it's a really great advantage to be an S corp. Not everybody should be an S corp. Not everybody's ready to be an S corp. So just make sure you check with your accountant on when that time comes. And I'm always asking this question when we see around, we'll say put a range 50 to 100K of profit, the math starts to be in favor of being an S corp because you'll save money. That's why we want to do it, right? And then make sure it's the right decision for you. By the way, there's some states, if those of you don't know, that being an S corp is not an advantage because of state taxes. So again, not just do it for the federal side, but make sure you check on your state rules. Oregon is not one of them. We're good. We can be an S corp. It's fine. It's great. And you will save on taxes. Okay. Ooh, so many questions. Okay, I triggered something. Okay, let's see what's going on here. Okay, so some of you didn't know that. That's good to know. So just to make sure, and then consult with your accountant, your own personal situation, but those are the rules from the IRS. Now, I did not create those rules, just in case. What documents should we keep for owners' roles on the business for possible IRS audit? You are required to keep receipts of any business expense. The way I do is I just take a picture and put it in a Google Photos folder. So if I ever get audited, I'm like, here's the folder with all the receipts. It's like the easiest way I found. Some people like to attach it to their QuickBooks transactions. They have the app and, whatever. I don't care how you do it. One thing is paper receipts do fade. So make sure you have a backup to that, and ideally electronically is easier. All in one place. I believe they can go back up to 7 years, I think. Don't quote me on that, but I think there's they can go back several years. So make sure you have your records, your taxes file, all the things that they might ask for. And here's the thing. They will audit you for one thing. And by the way, I had a friend who went through an audit. So we've talked about this a lot. And it's like they go through audit for this reason, but in researching for that, they find there's another discrepancy. Now they're opening everything else. So just, we want to be cushy. We don't want to trigger any audits. We want to follow the rules. Everybody wants to save all the taxes. Everybody's like, how do we pay zero tax? I'm like, if you're paying tax, you're probably making money. Just saying, I'm good with profit. I'll keep my 70 or 80%. I'll pay the government the other, 10 or 20 that I'm owing to them. That's okay. Because I'll get to keep the rest. So just, don't be doing those TikTok advice on tax savings, because some of those can trigger audits and red flags for the IRS because they go after those people. So do it legally, work with your accountant to do it the right way, prevent an audit from happening, keep your records for as long as necessary. Okay. How to set up a realistic pro forma for a brand new business. Ooh, great question. Let's go through that in this example on the spreadsheet. Okay. Understood. Oh, so someone's getting a payroll audit. Okay, forget at a level of IRS audit, take look around. Yeah, so if you're going through payroll audit, hopefully you have a payroll company or a good system to run payroll through. If you're running payroll on the spreadsheet, at least you have records. So there's that. But if you want to save yourself some travel, sending your payroll quarterly to the state and federal is really important. Recording hours, even after employees leave, you're required to keep those records. So just FYI, for those of you who have employees, W-2s, make sure you're up to date on rules around specific requirements on payroll, both federal and state level. Oh, nice. So they had payroll software. So they had all the business cover, and now they're just going through the records, which is no fun to get audited. But if you have things in order, you're not going to get in trouble. So as a business owner, just make sure you're following the rules. And if you don't know what they are, go consult an HR consultant for an hour and find out what it is, and then go do it. It really can be that simple. It doesn't have to be complicated. Sometimes I think we make it a bigger thing than it needs to be. And payroll software is actually intended to help you solve for those things so you're not, in trouble when that happens. Okay, let's talk about the P&L, and then I'll talk more. I'll answer some more questions. So I've seen many P&Ls by now. I don't know, over 200 businesses at this point, P&Ls. And I'm always shocked by what I see in P&Ls. So I'm going to walk you through what not to do. And this comes down to bookkeeping, which we also do for clients. That's another service. But these are the issues we see often that we're correcting for bookkeeping teams. So I want to make sure you're getting that so that you can work with your team to get those fixed. Things that I see is business owners tell me, I pay, people pay me by PayPal, Stripe, Venmo, whatever. I'm like, that's great. What does that tell me about your business? That you do more business from one platform to the other, but doesn't really tell me how you make money. So what if instead we said we offer service number 1, product number 2, and we know what those are because we have a name for it. This is what we sell. People buy these things, right? This service offer, this product offer. Maybe you have 4 different types of cattle that you sell, or you have 4 different types of vegetables that you sell from your farm. Like, I would want to know, what are they? Which is the most popular one? Which one makes the most money in my business? Those are the questions I'm trying to get answers to, because as a business owner, I'm trying to manage the business. So in my case, I'm a service provider. So I'll have CFO services or monthly retainer. I have quarterly clients, I have projects, and I have programs and partnerships. Because now I know, hey, when I partner with this program, is that yielding the results I expect? Hey, when we take on a quarterly client, is that growing over time or is that shrinking? Are we losing clients? Are we getting clients? Are we charging right? And then I can run margins on that too, by the way, the reason why we do it this way. So if you haven't split your revenue, sometimes I just see like one line, income. I'm like, how do you make money? I don't know. From looking at your P&L, I have no idea, which is totally fine. This is where we start. And now we want to split it by type. Which service, which product, product number 1, 2. Also, don't do like 10. This is where we want to keep like a 3 or 4 ways that we make money, because we also don't want to make it so unmanageable that your bookkeeper is going to fire you because it's just so much work, and they're not going to do it right anyway. So bucket it into like categories that make sense for your business, and then keep it streamlined to like 3 or 4 that makes sense. We also want to track discounts. I see often you guys are recording income without the discount part of it, like the merchant fees or anything that goes on. I need to know what merchant fees you're paying so we can state revenue correctly. It's not going to change the overall outcome of your business, but we need to record gross revenue, net of discounts, fees, anything, refunds, and then what is our net revenue in our business. So if you're not doing that today, go run some reports. You could do a once a month journal entry to adjust for that. It doesn't have to be complicated. Make sure we have the data and the information, because now we know, hey, are discounts out of control, or is our merchant fees too high? Do we need to change POS service providers? Like, we can make decisions with that data. Okay, I'm gonna pause there because I'm getting a lot of questions. So let me make sure I didn't miss something. Nice. Okay, what do you think are some of the red flags to look out for on P&Ls besides the big influxes? So yeah, so definitely on the trends I spoke about, anything that goes up high or down low, that's like unexplainable, right? Unexpected. If it's something you made a decision on and you knew it was coming, like I'm not going, like, that, right? So you're going to be like, oh yeah, I spent extra that month on this thing. Okay, great. But if it's like unexpected, you committed to and that's going to continue, that's a problem, because now we're at a different level of spending than we were before. Are you still profitable? Will be my next question. Red flags. Also, drop in spending. Like, I see it often, like there's monthly rent and then there's no rent. I'm like, what happened to your rent? Do you not pay it? And the client's like, what do you mean? And then they find out that they send the check and it was never cashed. And now they have a late fee on their account. Like, these are the things that we need to be paying attention to. It's missing. Why is it missing? We paid it. What happened? It never get to the owner. Like, we want to make sure they cash the check. They don't charge us a fee. These are important questions to ask. Yeah, if you made a big sale in a month, like, ask why, who was it? Can we do more of that? I'm like, what client was that? Let's do more of that one. That type will help us make a lot more money. Let's go see what happened there. And can we replicate that result with our team's support? Maybe they can help you, like, oh yeah, that was from this situation and then that happened and they order a big order and they're going to order again in November. Great. Now we can forecast that. Okay, a brand new business forecast. So it's going to look like a lot of expenses, no revenue year 1, which is very common for when you're starting a business. And I still need you to track it. I know it's going to look terrible and you're going to be like, I don't want to look at this number, please. And it's like, you have to record your expenses because those are write-offs. Those are benefits that you get for starting a business. Money you put in, record as owner's equity into the business. And then you're spending down, right, on equipment or whatever it is that you're buying. Maybe it's labor, maybe you're buying some supplies, materials. Recorded year 1. when you're forecasting, it's going to look a little different because there's going to be a lot of assumptions. There's going to be like, maybe we get 4 customers, maybe they pay us this, until you start to validate some of those assumptions, then you'll replace it with real data. So a lot of that forward looking, we are definitely assuming a lot of things are going to happen. Then you got to say, okay, what do I need to do to make those things happen? So that's a little bit more challenging, but not impossible. And it just takes a lot of, documenting those assumptions to make sure they're coming to fruition. Okay, and yes, the SBDC has a lot of resources, templates, and things around projections. So make sure you read that up. When we do startup projections, there's a lot of questions we ask around assumptions to make sure we're correct, or directionally correct at least. Don't try to be perfect. It's not going to be. Do you recommend splitting P&Ls by class? So yeah, so some of you might have in QuickBooks the functionality for classes. So if you have several locations and you want to track each location's performance and you want to tie a class to it, so you can pull a report by class and then it'll automatically split your P&L like this way by location. So you'll have like 3 columns by location. And then you can run reports monthly by location as well. So it gives you more information. So yeah, definitely use the functionality if it's there. I got some thumbs up on that. Okay. Merchant fees as an expense and not a discount. Is this wrong? It's not wrong. It's the same outcome. When we put merchant fees against cost of goods or up here in the revenue line, it will still lower your revenue. So as long as it's doing that, it's doing its job, it's fine. You see, I have 2 different kinds. I have refunds and discounts up here because it directly impacts revenue, where merchant fees is a cost of delivering the service or selling the product. So we're going to track it on their cost of goods. It will still net off of your revenue regardless. So just to let you know. And the transaction fees. Yep, that's fine. Or expense say for. Oh yeah, great example. So let's go through that. So someone said revenue stream types, right? So they have farmers markets, they have a CSA, and they have on-site sales as the revenue streams. Fantastic. Now I can tell from your P&L which one is yielding the most revenue. And sometimes we think it's let's say in this case, a CSA, and it actually was farmers markets. And you're like, maybe I need to do 3 more farmers markets next month instead of more CSAs, right? Or maybe I need to grow my CSA business line because we want to double down on that and be less reliable on farmers market because it's only seasonal. Like this is where we start to make the strategic decision making, because now we have the data points to tell us which one is doing what for our business. On-site sales, same thing, right? If you're like trying to grow that, and then they use inventory in pounds to map out what veggies sales best offer, best profit. Yeah, so then you have inventory costs that you need to map to each of the offers in that way too. So maybe it's like cost of goods sold for CSA, cost of goods sold for farmers market. And maybe underneath that even says like the type of things that they are, maybe it's boxes, packaging, delivery fees, ingredients or raw materials. So you can even go granular with labor. That gets a little bit trickier if you have to assign labor to each, but maybe you track your labor by farmers market, labor by CSA, labor by on-site sales, and you can run margins on that. You could also run margins at this level. So I'll talk about that because it can get pretty granular. And this is very detailed work that we normally do too. But if you're like trying to keep it simple because you only got, 30 minutes a month to look at this, I don't want you running like at that level yet, but you can. They track farmers markets separately because I know which markets have the highest sales. Great. So now you know by market where you should be and how much in sales you're making every month in revenue. That is fantastic because that information tells you maybe do you need to open 2 booths in the different corners of the market in that same market? I don't know. Like this is the ideas and the things and opportunities we would be asking about to make sure that you're, doing the most with the information you're getting there. Okay, let's move on to cost of goods. So cost of goods sold are going to be directly impacting revenue. So like without this, you can't generate revenue. So think of your direct labor wages. So if you're a farmer, like if you have farmers out in the farm, harvesting, like this is your direct labor hours in order to be able to get your product ready for sale. If you have farmers market booths, maybe the people working at the booth on those hours are going to be your direct labor costs, because without them, you would not make a sale. Maybe there's supplies, raw materials, merchant fees, like I mentioned before. Maybe there's other miscellaneous types, packaging, shipping, those type of things will land in cost of goods because without that, you could not make the sale happen, right? Now, I always get a question, should I, the owner, because I work in the business kind of thing, and I'm at the farmer's market, but should I be a cost of goods? And the answer is like, it depends, because you could allocate a portion of your time to the direct labor wages piece when you are at the farmer's market. And then when you're not, you're an operating expense. But that gets tricky. And then sometimes we just streamline and say, well, the intention is at some point the owner will work in the business. So you'll just be overhead cost, meaning operating expense. So we just don't count you in wages. But again, if you're 100% the person at the farmer's market doing all the work, then maybe your wages should count in direct labor for that particular instance. So this can be very granular and complicated if you let it be. So I just try to keep it straightforward and not make it a lot more work. And also your bookkeeper is not going to know. So you got to tell them what's going on. Okay, why we care about cost of goods? Because we want to know our gross profit, which is a gross margin calculation. So I'll show you how we do that. So we take revenue minus cost of goods sold, and then that divided by revenue will give us our gross margin percentage. We talked about gross margins, why they're important. Now we're going to talk about why we care about this. And why we care is because as your business grows, you will notice this margin will either increase or decrease over time. So as your business gets larger, expenses also go up. So if you're not managing to this margin percentage, you don't know your business last year that was maybe half the size of this year's business, is it doing better or worse? Like, you're trying to answer that question, and you can't do it if you're comparing absolute dollars to absolute dollars, because you're like, well, it's bigger now, so it takes more effort and more workers and more labor, more supplies, more sales. So this right here as a percentage is going to help you compare apples to apples to previous years, to other businesses, to other industries. And you'll be able to say, okay, is my gross margin percentage what it needs to be? Is it healthy? Get this question a lot, and it depends on your industry. We are trying to aim for at least a 40% gross margin in businesses. It can be higher depending, like in a service-based business, your gross margin could be 70% because there's not a lot of, expenses to be a service-based business. In a product-based business, it's probably closer to 40, 50%. And that's what we're aiming to manage to. And so we have to keep our cost of goods sold under control in order to be able to aim that. If yours are higher or not, don't worry about it. Go work through, okay, what am I spending money on? Where do I need to cut back? Where can I be more efficient? What hours am I allocating the cost of goods? Do I need to change those hours so that my labor goes down? And that's a little bit of the work that we help guide to make sure that you have some of those tools to make those changes in your business going forward. Okay, and I'm measuring this monthly every year. I'm comparing this year to last year, just to make sure I understand what's happening with my business as it continues to grow. Okay, let's see, any questions? Oh, nice. Okay, so some of you are aiming for a 51% gross margin. Fantastic, that's even better. Whatever you're doing, keep doing that, because it just leaves more room for profit. Like, this is why we manage margins, by the way. It's because we need to have room for profit after we pay expenses. And there's not going to be enough room for profit if you aim for something lower. I have seen businesses that survive with 30% margins. It's not unheard of. They just have a very lean operating expenses. So, like, again, it's all relative, right? So making sure that you, at the end of the day, are measuring profit, which we're going to get to in a minute. And it starts with margins. So, okay. Let's go through expenses. So every time I talk about this big categories, there's always a categories nested underneath it in your P&L, as you guys know, because you've seen your P&Ls, right? And then there's components to this. There's payroll costs here. Maybe those are the highest: rent costs, office supplies, advertising and marketing. Those are pretty standard categories that we see in profit and loss statement. By the way, these categories are defined by your chart of accounts. If you never heard of that term before, it's an accounting term that says how this is named, and how this is named is how it's going to be translated to your tax return. So your accountant might have preferences on how they want to see this. We as CFOs also have preferences on how we want to see this, because we're trying to measure financial performance of your business. And we will also at the same time want to serve the tax purposes. So we kind of want to work them together to make sure the categories make sense, both from a financial management performance and a tax compliance aspect of it. And they do overlap, by the way. So don't worry, we're not doing something creative here. It's the same standardized that we use. We're going to start using things like percent of payroll to revenue to understand, hey, how is my revenue growing as my, how's my payroll cost growing as my revenue is growing? Is it healthy? Is it too much payroll, not enough revenue as a percentage? Is it too little payroll to too much revenue? Is your team overworked? Is your team underpaid? Is your team about to quit on you? Like, these are indications, right? So we're trying to get early insights into what's happening in the business. And ultimately, we're going to have our total expenses. We should never exceed your total revenue. Now, in this case, we have cost of goods, so we have to factor that in too, right? So it's cost of goods plus expenses should never be above your revenue. And then ultimately, we come up with a net income. Now, the net income could be $5, $500, $500,000. At the end of the day, we want to know as a function of revenue, so percentage of revenue. So we'll take net income, aka profit or loss, and divide it by revenue to get our percentage. This percentage is what I want to measure at the end of the day. It's like what's left after everyone gets paid. And maybe you're included in payroll or you're not, depending on the conversation we just had about entity. But this right here, I'm going to be monitoring every month, every quarter, every year. I'm going to compare to last year, to last same month last year to see are we doing better or worse, especially if your business are seasonal, like you get better in the summer, you get more traction in the summer, and then you slow down in the winter. Like we want to make sure we're mindful of that. So we're budgeting accordingly and saving money accordingly. And then this percentage right here is going to tell you, is your business financially healthy, sustainable, long-term or not? And this is the one I was talking about between 5 to 15%, ideally up to 20% for your type of industry in profit. And if you're doing more than that, like you're killing it. So like you're doing great. And I get asked this all the time by clients, like, is my profit healthy? Like I have no idea. And that's why we give us guidelines and we try to get them to, right? Closer to that 20% mark if possible. And it's all in how you manage your costs, how efficient your team runs, and how you're growing your revenue with the same size team, ideally no more hours. So these are, things you can work through. Oh, thank you. Yes. So these are overhead, great clarification. So these payroll costs are not your direct labor wages. These are people delivering the service. And then you might have, let's say, an office manager. You might have an assistant. You might have whoever else is on your team that's helping you. It might even be your compensation here, right? Maybe you have an operations manager. That type of labor that's overhead, above and beyond, your people in the field doing the work, delivering the service, that's what goes here. Okay, so if you have a big office admin staff or leadership team also, like if you have people that are leaders under you that are helping you manage departments that are not necessarily delivering services, that will go here too. So great clarification. Higher profit. Okay, so I get a question. If you're an LLC living off of draws instead of payroll, then you'll want to make a higher percentage profit. I'm assuming correct. I think everyone's goal should be to make a higher profit percentage, no matter how you pay yourself, because you own this company. So at the end of the day, you get to decide how you distribute profits. Now, if you're living off of draws because you're just an LLC and not an S corp, your draw will come out of this profit. So the higher the profit, the more you can draw from the business. But I also see where business owners draw above and beyond what the profit is because they have it in cash flow, right? Because they have the cash reserves. And then they're wondering whether their business is starving. So make sure you're not doing that. And if you're doing that, it's maybe 1 month and then you recover and then you're good again. So, but this is where you get to decide what that allocation should be. What I was saying is you can do 50% of this and leave the other 50% in the business to reinvest in growth and probably still be okay. Again, with some caveats, right? Okay. Okay, I'll address the private question in a minute. I'm going to skip over that and come back to that. Where do loan payments fall within the structure? Oh, great question. So, okay, so two places loans are going to fit in. One is definitely your balance sheet, okay, which I don't have here as an example, but the other statement, remember like the 2 out of the 3 I talked about? Okay, that one, and they're liabilities for the debt that got paid down. So it needs to be going against that balance on the debt. The other places, it will show here, but it's only going to show the interest portion of the loan payment. So like you're not recording the principal. When you have a mortgage, you're paying principal and interest, right? Same thing with any loan you have in the business. There's principal and there's interest. Interest goes in the P&L. Principal goes in the balance sheet. So if you're recording the full loan payment in your P&L, it's wrong. fix it, change it, please. Make sure you work with your team on that. They only should be recording the interest portion of your loan in your P&L as interest expense in your business. Otherwise, you're not stating your profit and loss correctly. And I'm sure your accountant will ask questions and help you change it. And you could also just do a one-time a year adjustment to record the full 12 months of payments. You don't have to do it monthly, but I like to see my P&Ls monthly, so I want everything included, including the interest on our loans, to make sure we are, managing accordingly, because we are paying those monthly. Okay, great question. Do workers' comps, benefit, retirements get rolled into one line for direct line wages, or is it split of COGS and other related expenses? Yeah, good question. So you can split wages into these subcategories, and we do recommend it because you might get asked a question. So when we're doing bookkeeping, we will do a workers' comp line, a benefits line, retirement line. We will also do actually an owner's compensation line for the wages of the owner, so that we can clearly know what that is, so we don't have to go back and look at payroll records to find that. Your accountant loves seeing that too. And then any owner's benefits, like if you're paying for your health insurance or anything else, owner's retirement can be, it's called officer salary or officer compensation. And then you follow it with like benefits, officer, compensation, insurance, whatever it is that you're paying for on behalf of the owner. Especially if you're an S Corp, that's important because it's going to go on your tax return. So they're going to want to know. So yeah, there's subcategories. And even here, you can have direct labor wages and break it out by all the subcategories within that too. You always have a total, so it's fine. Okay, great questions. What about the direct wages and costs? I think I just answered that, but let me know, Jennifer, if I didn't address that in like the cost of goods section for direct wages. Okay. If you don't have time to look at your full profit and loss statement, right? What I want you to look at, if nothing else, is 4 numbers. I need you to know what is your revenue for the month, what was your cost of goods. You need to know what are your expenses. Sorry, it's scrolling all over. And what is your profit? Like literally 4 numbers. You can probably find 5 minutes in your busy schedule as a CEO and owner to go find out what those 4 numbers are. That right there is going to start helping you understand what's happening in your business. Now, if you have more time and you get curious and you start to ask questions about, why is my revenue higher? Like, wow, we had more profit than I thought. This one always gets me when I review P&Ls with clients. They're like, oh, I thought we did half as much this last year. Like, actually, your business was double as good as you thought it was. Fantastic. Like, because they're not looking, right? And I know there's like this fear. So I want you to gently work your way through being able to confront your numbers, whether they're good or bad. Again, if they're not where they need to be, take that as information and then go work the plan to make them better, right? Because again, what gets measured gets managed. Okay, so then clarifying question on cost of goods. Why is there no benefits taxes for the direct labor under? I just didn't break them down. You can. There could be 3 more lines here that break down the details. I'm just keeping a high level for this example. But yes, they can be, there will be taxes, benefits, retirement, if you do a 401k match, those kind of things here. Any other benefits that you have for your employees will be, I'm just illustrating the total. But yeah, there will be plenty of details all along in your P&L that you can expand on if you choose to. Yes, the 4 things I said were key are the ones highlighted in blue here, and you'll get a copy of this, by the way, is revenue, cost of goods sold, total expenses, and net income, aka profit. What is the formula for profit? It's profit divided by revenue. It expresses a percentage. And you'll get access to this, so you can take a look here and like you can open up the formulas to see how things are calculated if you guys have questions later and you're like, what was that again?
It was expenses divided by revenue. Expenses divided by revenue.
Oh, they want to see expenses divided by revenue?
No, the formula for profit, you said profit divided by revenue.
Yeah, it's profit.
Yes.
Yeah.
Sorry, I might be confused.
Did I say expenses? I'm sorry. I mean profit, this line right here, line 41 divided by line 11, not expenses, profit, because profit is the outcome of taking revenue, subtracting cost of goods, expenses to get profit. Okay, so that's how we walk through. Thank you. If I said it otherwise, that's not what I meant. So yes, net income is revenue. Sorry, net income. No, net income is profit. Sorry, whoever posted that. Oh, net income, the bottom line is profit. I know it's confusing because it says total income. So at the top where it says total income, that is revenue. Okay, just posting there to get everyone. Okay. I'm saving the private question to answer a little bit later. Any other questions about what we cover?
We have one, are COGS the same as direct expenses?
Where is that? Direct expenses. If you mean by direct expenses tied to producing revenue, then yes, but we call them cost of goods sold, because it can get confusing if you call them expenses. Expenses are after we've paid for our cost of goods sold. So think administrative, operational, like if you were to cut most of this tomorrow, you could probably still make money with it because you have your team that's directly delivering on revenue and is directly tied to making the revenue happen. Oh, direct and indirect expenses. Yes, that's another way to think about it because it's directly impacting revenue versus the expense side, it's indirectly contributing or impacting. Yeah, so those are like fixed expenses, right? Like when you think about paying rent, you're gonna pay rent even if you don't make $1 tomorrow. Like your landlord doesn't care if you didn't make sales this month. You still have to pay that rent check, right? So that's a fixed expense, indirect expense of the business. And in some cases, you might be able to ask for some support there, but for the most part, you gotta pay the rent no matter what, no matter if you made $1. Okay, and let me see. Jesse, you had a question. I'm happy to answer that if you want to stick around if you have a minute. So anyone else have any other questions? I'll switch back to see if this works. Tell me. Oh yeah, okay. Ooh, that worked. Perfect. Okay, and I know some of you have to run, so I'm not gonna keep you the whole time if you have somewhere to be. I will be here for another 5-10 minutes each answering questions, so please let me know if you have any. I have a private one that I'll answer after we stop recording, so if you want to stick around, we'll have that. Jesse. Anyone else? Was this helpful? Give me a thumbs up if can't see all of you, but okay, I see a few thumbs up. Good. Oh, yay. Okay. Lots of thumbs up in the comments. Fantastic. Okay, here's where to reach me if you want to follow up with us. We're all over social media. We put out free content. We have a newsletter with information. Feel free to sign up for that. No strings attached. We just want to close educational gaps around financial management in companies and businesses so they can be able to employ people and do the impact that they want to make, but you can't do it without profit. So we got to fix profit first so we can have the impact we want to have as businesses. And we've been in business for 8 years and we're just very passionate about this subject matter, which is can be tricky to navigate on your own if you've never gotten education on how to manage finances in your business. But today you were here, so give yourself a pat in the back for showing up for yourself and your business, and you will just be that much better implementing all the things we talked about today. So, Sydney, anything else?
Yeah, I will be sharing the recording out later this week, along with other information and resources from the Northwest Rocky Mountain Regional Food Business Center, which is what has brought you this great session today. So hopefully you'll get all connected with all of our resources. I think that's it that I have. Amy, did you have anything you wanted to add? I'm going to say no. She may or may
All
not.
good
There
from
you
my
are.
end. Thank you for this. This was incredibly helpful, and I'm excited to share the recording with even more folks that couldn't make it live. So really appreciate you, Carla and Sydney, for facilitating and organizing all this.
Thank you, Amy. Good to hear you again. Okay, if you want to stop the recording, I'm going to answer the question.